My name is Tara Unverzet, and I am the president of South Bay Financial Partners. I'm here today to explain about how investments are taxed. We get a lot of questions about how, when you invest in something, how it gets taxed, when it gets taxed, how much it gets taxed. And so this really comes down to talking about capital gains. Capital gains is a fancy word for profits or gain or increase in price that you've had on your investments. So I decided it was the easiest to explain this by giving an example. So we're going to start with a fictitious situation, and I want to give a disclaimer right here. This is all completely made up, 100% fiction. I am not giving any investment advice of what you should or shouldn't invest in. This is for educational purposes only, and is just an example to show you the concepts that are involved. So not making any recommendations here or giving investment advice. So if you were to buy 10 shares of Apple stock at $100 a share, you would have a cost basis of $1,000. So those 10 shares would have $100 per share. $10 times 100 ends up being $1,000. So your cost basis is $1,000. Cost basis is another term, and that's basically the money that you spent to buy these shares. So 10 shares you bought for $1,000, that's your cost basis. That's like your starting point as far as the IRS is concerned, or taxes are concerned. So next up, say that a year goes by and you have that 10 shares, and now instead of it being worth $100 per share, now it's worth $150 a share. That means that the fair market value, the fair market value is if you sold those 10 shares on the market today, on this day that it's worth $150, those 10 shares would bring in $1,500, $1,500. So that's the fair market value of those shares today. So you have your cost basis, which is what you paid for those shares, and then you have the value of those shares today. That's the fair market value. The difference between those two, so the $1,000 or the $1,500 fair market value today, subtracting the cost basis, what you paid for it, you come up with $500. And that $500 is basically your profit, and that's also called capital gains. And if you don't sell the stock, then those capital gains are unrealized capital gains. That means that you have that gain today, but you're not selling the stock today, and therefore you're not taking those profits today. And because prices can go up and down every single day, it's unrealized because you're leaving the money in those shares. You still have the 10 shares, and that the fair market value is going to go up and down. So it's unrealized profit of $500. And then say another year goes by, so this is year 2 now, and say that the stock now went down to $125. So you bought it at $100. Last year it was $150, and you made a $50 profit on every single share. Now it's $125. So it's gone down $25 from last year. And so those 10 shares are now worth $1,250. And remember, I said that $500 in year 1 is unrealized, and this shows what that means. So you didn't realize that 500, you held on to them, and so now you only have $250 of profit, or $250 of unrealized gains. So because you didn't realize those gains, you didn't sell that stock when they were at $150 per share, you left the opportunity for those shares to go up or down. And in year 2, they went down. And so that $500 profit turned into $250 of profit. And let's say that you decided to hold on to them. This wasn't the time to sell. So in year 3, they went up to $200 a share. So you bought them at 100. And so those 10 shares, your cost basis, what you paid in was $1,000. At one point, they went up to $150 a share, or $1,500 for the 10. Then they went down to $1,250 last year, and now they're up to $2,000. Woohoo! Now we're winning. Now we're in the money, right? And so this is year 3, $200. You paid $1,000. You have $1,000 gain. And so that $1,000 gain is we call it $1,000 of unrealized gain. And now you're sitting on that. So it's unrealized still. You're still holding on to them. You haven't realized anything. So say that at this point you're saying, I don't want to take a risk. I don't want to have that go down like it did 2 years ago, but I want to keep some of it in. So since I've doubled my money, I'm going to take half the money out. I'm going to take out what I put in. So you put in $1,000, you got $1,000 of gain. You have $2,000 right now. $1,000 of unrealized gains. You're going to sell 5 shares of that to bring it back down to $1,000, what you originally invested. Those 5 shares are made up of $100 of cost basis and $100 of gain. And so when you sell the 5 and it's $1,000, of that $1,000, $500 of that is your cost basis. You paid $500 for those 5 shares. And you're getting $1,000 back. The fair market value for those 5 shares today is $1,000. So you have unrealized capital gains of $500. And now you're selling them and you get that $1,000. Now that $500 of unrealized gain turns into realized capital gains. You have realized that gain. You sold those shares, you realized that gain, you took that profit off the table, and now you're sitting with $1,000. And of that $1,000, 500 was what money you put in to buy those shares, and 500 is pure profit or realized capital gains. So that's how you get to the realized capital gains. And the realized capital gains is really the part that affects your taxes. So you never get charged taxes on that $1,000 that you put in to buy the 5 shares. You do get taxed on that $500 profit. And capital gains is not taxed in the same way that your income taxes are. So your wages, so that's your salary, any side gigs that you do, any earned income, and any interest, any unqualified capital gains, won't go into that, and some other things. Those are all taxed at your income tax bracket. And we talk about income tax bracket all the time, but there's also another tax bracket, and it's the capital gains tax bracket. And the capital gains tax bracket starts at 0%, goes to 15, goes to 20. And it depends on what your income is as to where you go into there. So I'm not going to talk about the tax brackets or how many, are you going to pay 0%, 15%, or 20%? Know that this $500 realized capital gains in the situation could be taxed at 0% if you're in the 0% capital gains tax bracket, or it could be taxed at 15 or 20%. So it's going to be taxed as capital gains, not as income. That's the main thing to know. And how much that is depends on what capital gains tax bracket it is. You need to talk to your tax preparer about that. You can sign up for a one-on-one if you want to talk to us about what your capital gains tax bracket looks like. So that $500, when it's realized, does get taxed. As long as it's unrealized, as long as you haven't sold it, it does not get taxed. But once you realize it, then you have to pay taxes on it, and it's taxed at the capital gains tax bracket. And note that there's a difference if you're invested in a regular taxable brokerage account, or if you're in a traditional IRA, a Roth IRA, a 401k, any retirement accounts. You actually never pay capital gains. Those grow capital gains free, whether they're realized or unrealized capital gains in a retirement account. Never pay capital gains on it. You might pay some other taxes. That's another video. But we're talking about paying taxes in a taxable account when you're invested in stocks. You would pay taxes when you realize, not when it's unrealized. And so when we look at what's left in there, so you started with 10 shares that you bought for $1,000. You just sold 5 shares. So now you have 5 shares left. And of that 5 shares, you've paid $100 per share. So 500 of those shares, or 500 of the value of the shares is your cost basis. And 500 is the unrealized capital gains that you left in there. So remember, we have 5 shares, $200 a share. 200 times 5 is $1,000. 500 of that $1,000 is cost basis. That's what you put in. Never will have to pay taxes on that. 500 of that is unrealized gains. You will not pay taxes on the unrealized gains of the shares that you did not sell. But note that because you didn't sell them, you didn't lock in that profit. So the price could go up or it could go down in the future. If it goes up, then your real unrealized gains will go up. If the price comes down, your unrealized gains will go down. They're unrealized, so they're still in flux depending on the price, the current price. And the current price, so that $200 times the 5, so $1,000, that's called your fair market value. Cost basis is the 500 you put into it. Unrealized capital gains is the $500 profit or growth that you had. $1,000, that total amount, is the fair market value of those 5 shares today. I hope that helped. If you have questions, please leave them. We'd love to hear from you. And you might prompt some more videos to explain what you would like to have explained. Thanks for listening.